Welcome everyone to today's personal finance series webinar hosted by StashAway. Last time we talked about how to invest with ETF, and this time we're going to talk about asset allocation. And can can everyone hear me okay? Yeah, okay, I assume so. So this time we will talk about asset allocation, invest like an institution, and to show you how we can invest from the institution angle. We'll start shortly at in 2 minutes. So please enjoy the session. Okay, all right. So a little bit about myself. Um, A little bit about myself. My name is Pacey, and I am a wealth advisor here in StashAway. So my role in StashAway, I'm responsible for covering our clients whenever you need a discussion about your investment in StashAway or your investment outside of StashAway for overall financial planning. I am here to assist you. And previously, I work in JP Morgan's private bank, also responsible for advising our clients on their overall wealth management needs. And StashAway, for those who it's the first time that you attended a StashAway webinar, StashAway, we are a digital wealth management platform to provide personalized investment and cash management services for individual investors. We operate across 5 regions, mainly in Asia, in the market. Here we are in Hong Kong, but also our headquarters is in Singapore. We also operate in Thailand, Malaysia, and Dubai. We are a company got licenses across these 5 regions. And in Hong Kong, we are regulated by HK's SFC. You can rest assured that your money is under the custodian of our custody bank, Citibank and HSBC here in Hong Kong. And throughout the years, we started in Singapore, and now we are managing over billions of US dollars of assets and also over 10,000 active customers across the market. And in such a way, we aim to be your personal financial secretary to provide simple, intelligent, cost-efficient services to you. And so that's why we are honored. We share the same philosophy with our advisor, Mr. Johnson. We are very honored to have him support our way through our growth journey here in Hong Kong. So without further ado, let's start it with today's topic, right? Invest like an institutional investors. So building a portfolio is hard. Then what do institutional investors do? That's the question on many investors' mind. And I will have to say that actually there's no secret secret wand of no magic wand of institutional investors. The main difference of what they do is that institutional investors, they invest systematically. I think the difference they lies in asset allocation, risk management, capital efficiency, and most importantly, they are being disciplined. And today, due to the short time that we have, then we will mainly focus on asset allocation, and we will also touch lightly on the other aspects that the institutional investors that they are doing. Okay, so first, let's start with asset allocation. How do you do asset allocation? It's actually nothing. It's as I think many of you might be familiar with strategic asset allocation. Every time that you talk to your advisors, they will always try to understand your investment objectives first, right? You will need to understand your target return, risk tolerance, and time horizons in order to set up a reasonable, achievable investment objectives. And on the other hand, you need to look into the products. So the products, many of the products, except for those bottom-up and event-driven ones, they are built on what we call capital market assumptions. What's your view in the for the market in the long term for different asset classes? So when you look into the products and capital market assumptions, three aspects that you need to look into: the return, the volatility, and the correlations among the different products with the market, so that you can come up with proposed strategic asset allocations with expected return and expected volatility. And that's the core for building any diversified portfolio that support your long-term financial needs. And that is goal-based methodology we use here in StashAway, and we also use it when tailoring the different general investing portfolios for our client. So many people have the experience of trading stocks. Trading stocks, when you trade an individual stock, it means it's a stock picking, it's a security selection. But not many people have the concept of asset allocation, not just about building a stock portfolio, but about building a portfolio with multiple different asset classes. And I think maybe people in Hong Kong, maybe over 80% of the people have buy single stocks, but not, I think maybe less than 20% of the people actually actively think about asset allocation. But interestingly, for any investors, 80% of the return comes from asset allocation, and maybe only 20% of the return actually was attributed by active security selection or manager selection. And that's why we here in StashAway ourselves, we think we are a asset manager instead of a broker. So for brokerage, it's best for trading. It's real time. It's also many of the brokers, they are cost effective. But here we do asset allocation to manage your assets for the long term. And why picking stock only does not work? So we check the data of the past 15 years, and especially in developed market like in the US. Across the US large cap, mid cap, and small cap mutual funds, over 90% of the fund managers underperform the market benchmark. And so nowadays, with the market being increasingly, I would say, efficient, of course, there will be inherent inefficiency in the market. But especially in developed market, with the markets being increasingly efficient, it is very hard to just beat the market, even for the professionals. So when we do asset allocation, it's important that we have the concept of asset classes. We can broadly categorize the assets into four asset classes. There's the stocks, bonds, alternatives, and cash, of course. And people ask, where are the gold? Because gold has been rising for the recent 2 years, gold is within alternative. And for many of the fund managers, gold is actually not a core allocation, I will say. And that's also the difference of StashAway. At this moment in our general investing portfolio, we use gold as a balancing asset. So gold is part as our core allocation, not now, but across the past 3 years. And this session is talking about institutional investment. There are many different institutions in the market, and which type of institutional investors that me as an individual investor should refer to. I think the best to refer to probably are the endowment fund and also the sovereign wealth fund. Why is this so? Because endowment fund and sovereign wealth fund, they are all long-term, extremely long-term investors. What they invest normally, what they invest in, they have a goal in mind. Not only they need to generate the return, but also they need to keep sufficient liquidity for the spending. For example, endowment fund, they need to keep the sufficient liquidity for spending for the operation of a university. And sovereign wealth fund, they need to keep the liquidity for the total stability of the country. So here, I want to use an example. That is an endowment of Harvard University. This shows how they allocate their assets. So for Harvard, because it's extremely long-term investors, a university with rich history, so on the contrary to many individual investors, they allocate a lot in alternative investments. So private equity and hedge funds actually it's over it's over 70% of their total allocation. And in the meantime, they also couple with other assets such as public equities and also bonds, cash equivalent in their portfolio. But I'm not saying that everyone should copy this strategy for a huge alternative allocation. But if you think about that, is the longer the time horizon you have, the more that you can afford alternative assets and illiquidity, and also investing in something for tomorrow. And people wonder, okay, that is their allocation. How about their performance? Harvard's endowment generated a 9.6% return for 2024. Many people think 9.6% is not too high. If I buy S&P 500 alone, I can exceed that 9.6%, right? Yes, you're correct. The difficulty here is not to achieving 9.6% in 1 year, but achieving similar return over the last 20 years. And Harvard is actually one of the best performing endowment funds in the world. So that's why I think I should show you this as an example for asset allocation. And for sovereign wealth fund here, we can also tell the story through some data. Here's the past 5 years sovereign wealth funds asset allocation. It's not a pie chart, but it's a little bit difficult to read through, but let me walk you through. So first, when look at the asset allocation we see in cash. In the past 5 years, you can see the cash position of any sovereign wealth fund in general is decreasing. What does it mean? It means that they are putting their money into work and adding risk into their portfolio so that they can generate a higher return. And where does those cash goes from? Well, cash position, as you can see, in general, they do not maintain too high of a cash allocation. But what we see that this slightly increase in is actually in equity and also in fixed income. So we know that in the past 20 years, a 60-40 portfolio may not work because in the low interest rate environment, fixed income does not perform too well compared to equity. But still, Nowadays, with also we're in interest rate cut cycle, having a fixed income can actually provide strong fundamental for your overall capital allocation. And if moreover, here across many asset classes is on par or slightly increasing. But we look into the second data point that I want to highlight is the alternative investment. So as you can see, among the alternative investments, what increase the most among the sovereign wealth fund is in infrastructure. So that you can tell that there were a few reasons. First, of course, is the AI development. Many countries and also private sectors are investing in data centers, broadband, telecom networks, for example. And also, in the meantime, because of geopolitical uncertainty, it's important for countries to start building, owning essential backbones of their country for national security purposes. So that's why that makes these asset allocation trends for sovereign wealth fund investors. And okay, this is their allocation, but what about their return? So in general, sovereign wealth funds, some of them are more conservative, some of them are more aggressive, but on average, their 1 year return is 9.4% in 2024. Um, so as you can see, it's similar to Harvard's endowment fund. When we talk about a target return for investors, we think that although high single digit may not sound too attractive to some investors, but if you can consistently do it across multiple years, 10 years, 20 years, it actually is very efficient and very good performance by achieved by compounding effects. So when we set up our investment objective, it's also very important to have a reasonable goal in mind. What's more, StashAway, in our flexible portfolios, we have selected over 70 ETFs for you to choose. Then some of the investors wonder, okay, so in general investing, you do the allocation for me. In flexible portfolio, you selected what you think is the best ETFs for us. How do you handpick those ETFs? There are three key pillars when we look into the ETFs, when we decide which one is the best. Liquidity, cost efficiency, and tracking error are the three areas that we look into. Liquidity, very easy to understand in general. The bigger the size of the ETF, the higher the daily trading volume of the ETF, the better the liquidity. And what I will talk more is the cost efficiency and the tracking error. So for to make it cost efficient, many people, the first thing that they look is the expense ratio. And it's a very important thing. It forms the fundamental, the base for the fee structure of the ETFs. But besides the expense ratio, I would say when we look into ETF, we does not only look for the cheapest one. You need to also consider the total return. When you trade an ETF, first you look at the expense ratio, but the second, you need to look into the tracking error of how closely it is tracking the index, how closely it's replicating something that you want. If there is always an underperformance to the index, you are losing some return in between for trading that ETFs. And what's more, bid-ask spread matters. So with an ETF with lower liquidity, usually the bid-ask spread is wider. So it also adds another cost for trading that ETFs. And many of us know that for taxes, for US ETF, for US listed ETFs, if it's dividend paying, then you have the potential to expose to US dividend withholding tax. And that's why what we think that for fixed income ETFs that we mostly use the ETF listed in Europe called UCITS ETF for you to trade the US assets. so that you don't your US dividend withholding tax exposure is smaller. However, it's not always the case is better because for equity ETFs, for example, even though that you have the potential to expose to the US tax by trading the US listed ETFs, but the tracking error of those US ETFs are much smaller. So that's why when we think about a cost of investing in ETF, it's important to take a holistic view of the total cost and the total return. And what tracking error, what I mean is that if we took an S&P 500 ETF as an example, that also explains why we prefer US listed ETFs for equity. The tracking error for example, LN is what listed in London and US is what listed in US. The tracking error of US listed S&P 500 ETFs are much smaller, meaning that you can get over 5 years, you can get a closer return to the total S&P 500 index. So the spread is the difference, the gap here is much wider than the potential tax exposure of the dividend withholding tax, because in general, equities, especially for US growth equities, they do not distribute too much dividends anyway. Okay, so just now we talk about asset allocation. That's our main part. Later, I will briefly touch risk management as well. So for risk management, we need to have a concept of the risk-adjusted return. So when we look into the stock, yes, they have high return, but also their risk is much broader and wider. So in general, across all those asset classes, these are the risk-adjusted expected return among the different asset classes. And anything with the equities, in general, they have a higher risk, but also higher return. And that also explains why diversification matter. So we look into the market turbulence. This is the data of the first quarter of this year. Now, of course, everything goes up, and then recently have a little bit turbulence, but this year is a really good year. But if we look into the data earlier this year, US equity was actually not doing too well. But does it mean that we need to completely sell off US equity? Not the case. You need to maintain your asset allocation. And now you see US equity is up again, recover all the loss in March and in April this year. You do not need to sell US equities. What you need to do is to have other assets in your portfolio. So here, you can see well, here we also have the gold, which was the best performing asset. Now is still the best performing assets of the year. And also global equities, ex-US. This year, we have Japan equity, also Europe equity, and Hong Kong's equity. They are all great performers this year. So that's explain we are not talking about diversification is not just about investing in different asset classes, but also is about investing in different geographies. Asset diversification can also be achieved by investing in like alternatives, as I have mentioned, because here shows the correlations between among the different asset classes. And if we look into the bottom line, 4 lines, as you can see, is that in general, alternative assets such as those private investments, they have low correlations with all the public assets. So by adding alternatives, it can actually be a potential good tool for you to further diversify your investment portfolios. So if there is any free lunch in the world, I think diversification is the only free lunch in investing. So this is something that anyone can achieve through strategic planning. So please do eat the only free lunch. And the third difference that I think institutional investors do is capital efficiency. What does it mean? In Asia, we actually have 47% of wealth in cash on average. And it's very different from the characteristics of the US or Europe. Perhaps in Asia, people are in general more, I would say, conservative, so that we would like to have liquidity on hand and have better control. However, that is exactly the opposite of institutional investors, where in general they have only less than 5% cash or cash equivalents on hand to increase capital efficiency. And when we want to re-optimize our portfolio by putting the cash into work, we need to take the economic condition of the market into concern. So in StashAway, we categorize the market as recession, good times, inflationary growth, and stagflation. And as you can see, in different economic regime, the equity market and the bond market, they perform very differently. So when you put your cash into work, the first thing that you should think about is where I am in the economic cycle. Are we in the good times or are we in recession? So we think that our economy now is still in the inflationary growth regime. So that changed since April 2024. Before that, we think that the economy is in the stagflation, where there is a high inflation and slower growth. But now the inflation is high, but not extremely high. We are not close to the 2% target yet, but slightly more, not too bad. And the growth, especially in the private sector, is very strong. So that's why we put our cash into work and tilt our portfolio into adding more equity and also adding some gold. So it's important to increase capital efficiency by putting cash to work, but also before you put cash to work, you need to have a judgment of the current economic cycle. The last thing that institutional investors do differently is by being disciplined. Here, what I want to show you is if you're standing in this point of the time after the Lehman Brothers, the great financial crisis in 2008, what you would do. So after been through the crisis and the market in the beginning of 2010, people think finally the market recovered and enter the market. Is that the case? If you enter at that point, you experience another drop, quite significant. It's also a more than 10% drop. However, the market goes up again and drop again. And at this point of time in July 2010, you might think, well, the market is going to collapse again, like what happened in early 2009. Is that the case? Unfortunately, the market does not perform as what people at the point of time would expect, and it keeps going up after 2010. If we took a much longer time horizon, what I show in the last three slides, what I show is just what happened in these 2 years. And if you took a longer time perspective, you can see it's basically flat. It took 2 years to recover from the previous crisis, go back to the level. If you were in that 2 years, you would think you experienced a lot. But if you took a longer time view, it looks super flat. And if you look at what happened now, we do still have a crisis such as the COVID, but now it increased like how many times? More than 4 times of the market in 2008. It's actually 175% of growth. But if you see it here, it's like 400 something. It's 4 times the market. So So yes, exactly. That explains why you should take a longer time view of the current of the market instead of focusing what's happening day to day. And how does it connect to the point that I make, discipline? So what makes us not a professional investor is that many people, including me, we go through the emotional roller coaster. So whenever the market moves, we move to optimism, being greedy, thrill, to panic, depression, fear. That makes us to make poor decisions. And the best way to become a disciplined investor and avoid going through the emotional roller coaster is stay invested. Here, what I show is that your investment value, if you miss the best 10, 20, 30 days of the S&P 500. As you can see, if you're not staying invested, you're always timing the market to buy low, sell high, you will miss the best days of the stock market, and there will be a huge difference in terms of value in your investment portfolio. So staying invested during regular investing perhaps is the way when for us the individuals to do disciplined investments. We do every day, we do not have the time to check and monitor the market from time to time. And studying the market actually is a full-time job. So when you cannot do it, the best way, the data shows us, is stay invested. And by saying stay invested in StashAway, we always promote a concept called dollar cost averaging. So you can do it monthly, bi-weekly, we completely automated it for you, easily to be set up in the app as well. So how we can help. So all the concepts that I talk about just now, they are all applied to our managed portfolio, general investing. In here is the return of the different risk level. Here is a sample of the conservative, balance, and aggressive portfolios. As you can see, in recent 3 years, great years for the market, and even a conservative portfolio or a balanced portfolio, you can achieve above 10% of return through investing in a globally diversified portfolio. And if you invested in this one, we do the automatic re-optimizing for you. So it's easy. What you need to do is to be disciplined. And besides the general investing that apply this institutional asset allocation concept that I just showed, we also have other portfolios to tailor for your needs, from cash management to thematic portfolio investing in the future, and also alternative investments. It's very simple. We make things very easy in one app. So if you're an existing client, I'm sure that you're already familiar with it. Feel free to provide us with feedback. And for new investors, please download it now so that you can start your investing journey. We have a welcome promotion for new investors for 3 months of free investing. And you may also book a 30-minute consultation session with us so that we can understand you in a one-on-one confidential conversation. That's it for the short session today. And if you have questions, now I know that we are slightly over time, but I will answer any questions that you may have. Okay, so I got the first questions here. Is cash actual cash or cash equivalent? So I guess this question is asking about the USD cash yield portfolio. So it's cash equivalent. Short answer is it's cash equivalent. It's not cash. So it invests in 0 to 3 months of short-term US Treasuries. So it provides that at this moment, the yield to maturity is 4.1%. So it's not like a fixed deposit that you put in the bank. And that's why it can provide better liquidity. So it does not need to be locked for a month, 3 months, or a year. I hope that answer your question about the cash part. Any other questions? If not, for those like if you do not have questions, feel free to drop the line. I will stay here for another 5 more minutes. If you have questions, please feel free to type in the Q&A, and I'll try my best to answer. Thank you. Okay, I got the second question regarding the cost efficiency. And how do you compare with other brokers, such as interactive brokers, etc.? In particular, the big spread part. I would say fundamentally, our positioning is quite different. We also use a broker for us to do the different transactions. In StashAway, Saxo is our broker. So when comparing us with the broker, our advantage is actually not the bid ask spread part. Our advantage is that we help you select it, and we help you select the ETFs that with higher liquidity, lower expense ratio, so that you don't need to do the research yourself. So when compared to them, they have everything. They're like a supermarket. You can feel free to pick anything, trade anything that you want. But normally they don't do that selection for you. So for StashAway, when compared to the brokers in terms of transaction costs, actually they might be even lower. But for us, we provide additional value-added services on top, so that when the client may trade building a flexible portfolios themselves, for example, they can trust that we have a full due diligence process to select those ETFs for you, so that they don't need to do the work of comparison again. So I hope that answered your question. And to that part, in terms of cost efficiency, our model is also different from the brokers. So for StashAway, in terms of the fee, you're paying a monthly fee for your total asset under our management. But in terms of trading, we as StashAway absorb the trading cost, so that when you trade with StashAway, you actually do not have additional fee in terms of transactions. So that part you can rest assured that we have taken care for you. I hope that answered your question. Okay, another question that I have. Can you talk a little bit about StashAway picks its thematic ETFs, specifically the technology enabler portfolios? Yes, sure. So the technology enabler portfolios are consist of 5 to 6 different ETFs, depending like period. We adjust it from time to time. At the current market environment, it's actually not that easy to build a thematic portfolio using ETFs, because first you need to have the availability of the different ETFs issue, because we don't construct the portfolio by picking single stocks. We construct the portfolio by adding the different ETFs. So that's the first difficulty. So what we do is that we first will build a universe for any thematic ETF that fall into the specific theme, technology enablers. And we conduct the ETF analysis using the key pillars that I've mentioned: liquidity, cost efficiency, tracking error, and also performance. We check all those 4 things when we perform an ETF analysis, and we do future projections and stress testing for the different weighting and combinations of those ETFs, so that we can construct a portfolio that is tailored to exactly the risk level that the clients choose. And then we do the risk management for the clients. So that's how we pick the thematic ETFs. And nowadays, I think with the active ETF markets is developing in future, we will have more flexibility in building a thematic portfolio using ETFs as well. I hope that it's sufficient for your question. Okay, another one. Are ETF selection done by people or algorithm or both? It's okay, so let me explain. So I think ETF selection, when we build so I think it's both, right? Short answer is both. So for our algorithm, it mainly we capture the macroeconomic data, run the algorithm, and then to make judgments of the current economic cycle. That mainly is what the algorithm do. And the algorithm also help us to adjust the weighting of the different allocation to the ETFs. But for the ETFs themselves, it inevitably will require some human work in. For example, when building the ETF universe or to see what relevant ETFs are available within a certain theme. Sometimes I think at this moment, still maybe a filter of or algorithm, or you can say using Bloomberg to shortlist those things is faster than you to build a dedicated algorithm in selecting the different themes. So yes, so for the ETF selection, it's both work. But we do apply a lot of analytics, apply the algorithm in the analytics part after some shortlisting. Okay, another one, two more. I think I'll answer this two more question because it's running out of time. This question, you mentioned Saxo is your broker. I assume in Singapore? Yes. Yes. So our company is a headquarter in Singapore. So that we have a master contract with our broker Saxo, and this is also uh detailed in our account opening legal agreement. But of course, if you're interested, you can check it. It's on our official website as well. They may not provide individual services here in Hong Kong, but they still have maintained the provide services for institutions. And StashAway, we are an institutional client. So hope that answer your question. Okay, the last one that I have, what I'm seeing it now is, how does StashAway invest in gold, ETF, or mining companies, etc.? So for StashAway, when we invest in gold, when talking about the gold in general investing, is invest through ETF. And the ETF that is physical gold-backed ETFs. So that's what we mean invest in gold. Gold is gold. So we don't replicate the gold trade by trading gold mining companies, for example, because there is still a gap between the performance of gold and gold mining company. It can be a proxy. Gold mining companies can also be a beneficiary of this total gold trend, gold theme. But yes, short answer is we trade gold using gold ETFs. Okay, it's 1:14. I can answer one more question, I guess, if there is any. If no, then okay, yeah, no worries. I don't want to drag it for I don't want to drag it for too long. So I hope you enjoy the session today. Like I said, if there is any question, now we also offer this 30-minute consultation session for you. So feel free to leverage the opportunity to talk to our advisors, being me or my other colleagues. And yeah, thank you for attending the session today. I hope if you're an existing StashAway client, I hope you're enjoying the investing. If you're not, I very much welcome. I hope you will consider using the services of us. Thank you. Have a great day, everyone.